is our spring state of the markets, and just want to thank everybody for helping us in our transition to Schwab, which was successful, but we would never want to do that again, and we never will. So thanks for everyone who helped us. Just a couple formalities here. Magellan Planning Group is a SEC registered investment advisor. And of course, this presentation is for educational purposes only. I'm not giving any personal advice here, so we always do that in person. No legal services. Those are provided by Magellan Legal. Tax and accounting services provided by Magellan Tax. And of course, these are just my opinion. Nothing here is to be guaranteed. And of course, past performance does not guarantee future results. How many times have you heard that, right? So this past Tuesday, we had a in-live presentation, and it was a fantastic group as usual. And we were all there together, and it was springtime, and we were loving it. So we had a great bingo after that, and lots of great prizes were won. So let's just jump right into the market now. We can see that this is as of the end of February, and you may remember that something very exciting happened right after that. But up until then, we really were just sort of, flat, about half a point. So nothing really going on there. But you can see that since January 2016, it's been just gangbusters, albeit with, a few pullbacks. And then we had COVID-19, and then we had a lot of inflation here. And 2022 was pretty rough for the dot-com group. Like the high flyers, because of the Mag 7, and they were down about 50%. But since then it's been really gangbusters. So most of that, of course, has to do with earnings, and that's generally what happens with our stock market is. The earnings will track, stock prices will track their earnings, and companies have become a lot more efficient, especially when AI has become more integrated into their everyday operations. So we see that. We also see a lot of people getting laid off and getting replaced by AI. So there's, good and bad. But from the company's perspective, health insurance is very expensive. And believe it or not, I mean, that really is part of it. I mean, AI doesn't require health insurance. It's a big part of it. So earnings are a big part. And then remember, this was January or February 27th. And then the very next day, February 28th, and that's when Israel and the United States attacked Iran. There's really no other way to say that. It's just what happened. And then, of course, global markets plummeted after oil prices surged past $100 a barrel. And, I don't need to tell you why that's important because, oil is basically a part of our world economy. It moves the tankers around, and it moves the freighters around, and it moves the heavy trucks around. And we have to have all that stuff to get our stuff to Costco, because if it's not at Costco, then what are we going to do? So big problem there. Obviously, you've heard this ad nauseum on the media is 20 million barrels a day going through that strait there of Hormuz, and Iran has definitely strengthened it, and there's a lot of mines there as well. So there's some mines, and there's some little mini submarines is what I've read, but who knows? There's a lot of misinformation, that's for sure. But you can see in the interim, and you've seen this on CNN, BBC, ABC, all those things. Iran has been lashing back out against its neighbors, and so I don't know if this is going to be over anytime soon. I know that's what everyone wants, but it's like Machiavelli said. I mean, you could start a war when you want to, but they don't always end when you please. So since this time, we have seen a pretty significant drop off in the market, and even today we're down a significant amount already too. So that is the S&P, and then of course we have definitely seen that in the Nasdaq. Even though this year so far we've seen about a 9% drop in the Nasdaq, and after today, that's probably going to be around 10%. So the Nasdaq, you remember, is where a lot of these tech companies live. And one problem with that is that's the tech sector, technology, communications sector. And obviously that's something that we've been following closely because, it's become a big part of our economy now. Jamie Dimon was recently quoted just about a month ago of saying that, there's going to be a cycle one day. And I don't know what confluence of events will cause that cycle, but his anxiety is very high over it. And so that's something that, not just him, but Warren Buffett and a lot of others are seeing sort of the same charts and numbers that we're seeing. And we know the history of the stock market. So here's what he's mainly talking about. He's mainly talking about the the tech sector leading the S&P 500. So back in 1999, when the internet was a new thing and very, very exciting, what was happening was those companies were becoming larger and larger and larger, and they became a bigger ratio, a bigger percentage of the overall S&P 500. And then, of course, we know what happened after that. That is back. So back then in 1999, 2000, about 45% of the S&P 500 was comprised of the tech sector and communications. They kind of go together. Today, that is the same thing. So we're back to that 45% of the tech sector, 45% of the S&P being part of the tech sector. And what most people understand who've been watching for a long time, and I'm sure all of you understand this, is that we have these sectors. And there's this thing called sector rotation. So that, like all things, things rotate in and out of favor. And in 2025, the last year, we could see that communications and technology were definitely the top sectors. And energy, real estate, consumer staples, healthcare were definitely the laggers. But if we go fast forward 1 year, we can see that that's completely flip-flop. So now technology and communications are either flat or down, whereas energy and consumer staples are leading the way. And that's just this year so far. Since the war has occurred, and that has just been exacerbated. So these are sectors, and every sector, is a different part of the economy. And clearly, have things like value stocks, which are energy and utilities, which pay dividends. And then you have uh, growth stocks like technology and communications, which take their profits and reinvest in research and development and try to create larger market share. And they both have their places, and they both have their good times, and they both have their bad times. And so what we're doing now is we're seeing at least the beginning of what appears to be sector rotation, where technology sector is rotating out of favor, and by doing that, the entire S&P 500, because it's heavily weighted in the tech sector, is going to be heavily affected as well, with or without the war. We'll just have to see. It could be just that the war is creating this confluence of events, just like Jamie Dimon was talking about, is maybe the impetus to start what's coming. So if we look at dividend yields, we can see real estate and energy are the value stocks. So that makes sense that they would be, paying the higher dividends, whereas technology and communications, those are more of growth stocks. So they're taking their profits and reinvesting in research and development and trying to gain larger market share. So that's what that's all about. But over time, we can see that definitely the value stocks, the ones like, the utilities and energy and that kind of thing, you know, they're much more stable. So we can see back in 2022 when the growth stocks took a 50% hit. I mean, 50% loss in 1 year is more than my clients are going to be able to stomach. And anybody who's retired or going into retirement needs just, that's just too much. Anything that drops 50% in a 12-month period is something that you really need to maybe own, but just not everything of, especially when you're retired and you're drawing income. But you can see how value stocks really fared very well during that period of time. And remember, value are the dividend payers. They're usually larger stocks, a lot of utilities, and that kind of thing. We can also look at asset classes. Remember how the asset classes move in and out of favor vis-a-vis each other. So we can see how, like in 2011, for instance, fixed income, which are the bonds, was the best performer, and emerging markets was the worst performer. If we fast forward all the way to 2024, we can see the S&P was the best performer, but fixed income was the worst performer. Same thing in 2025. First, fixed income was the worst performer. So far this year, fixed income has not done well. But on average, if we take a balance of all of these things, you can see that it kind of ends up in the middle. So never the best and never the worst. But you can see here where commodities were on the bottom for a long time, and then in the middle, and then on the bottom for a long time, and then a couple of years on top. And then we can see where fixed income has been on the top, then on the bottom, and then kind of in the middle, and kind of around on the bottom here for a long time now because interest rates have been so low. Interest rates have gone up, and the bond market has just recently started to act a little more normal, but we'll talk more about that in a second. If we look at global stocks, we've got developing countries, or sorry, that's developed. So that would be a lot of Europe and Canada and stuff. The United States has done pretty well over the last 2 years. You can't say it, but look at emerging markets. Emerging markets has done almost twice as good as anyone else. I mean, who would have thought that? So they've really taken off here lately. And a lot of that has to do with interest rates dropping. So interest rates emerging markets do better as interest rates drop. And it's hard to believe it's been that significant, but that's what emerging markets have done over the last 2 years. It's almost 60%. But if we look at the global market and we look at the size of these different countries to the total global GDP, it's hard to believe, but the global market cap, the United States makes up 62%. It was 66 just a few weeks ago, but it's now down to 62%. But still, that's almost two-thirds. So almost two-thirds of the entire world global cap is the United States. That's just incredible. Look at Canada there. You've got Europe minus the UK. You've got the UK in there. The UK is only 3%. I mean, that was our mother country. And now they're only 3% of global GDP. That's surprising to me. I'm disappointed in them, of course. Asia without Japan. And so, I mean, for us, that's incredible. I think that I wasn't aware of that, but I mean, I've been aware of it for some time, but maybe you weren't aware of it. Two-thirds, almost two-thirds of the entire globe's GDP flows through the United States. Let's see, global equity valuations. So again, even though the emerging markets have done so well in the last couple of years, their price earnings ratios are only 13. So they may still continue that run for a while. Our price earnings ratios are up or closer to 20, which is not too bad. But you can see these are forward price earnings ratios. So we're not looking at today's rates or today's valuations. If we look at today's valuations there, we can see that based on whether we look at price to earnings, price to book, price to sales, price to cash flow, price or dividend yield, these are the means. So these are the averages. And in every single case, we're either close to two deviations or over two deviations. Now, this has dropped since the war has started, of course, but still we're quite far out of the box here in terms of the averages. We can see that, these averages go back quite a while. So we're looking at a rolling 20, 30, 40-year averages on these on the mean here. But you can see that our high peaks are a couple deviations above that. So what does that mean? Well, that means that like all things do tend to come back to the mean. And so we would see consistently that over time, these would have a tendency to drop back. So we're going to take a look at that. The other thing that we're looking at is the CAPE, which is the Shiller price earnings ratio. It's just price earnings ratio. It's just adjusted for inflations. Now, of course, this has come down just a little since the war started. But you can see that our latest was roughly about 40, and there's only been two times before where it's been this high. So here we are at about 40, and then the time before that was, 1999, right about the dot-com. And the thing that you need to remember is where we are today is very, very much like where we were in 1999 because we've got these all-time highs. Where are these all-time highs occurring? They're occurring in the tech sector. So back then it was the internet. These days it's what? AI, exactly. So the time before that really was the Great Depression, 1929, right? So obviously a lot of things have changed, but human behavior hasn't changed. Humans are just the same as we've ever been. And whether that's good or bad, in a lot of cases, it's a lot of both. But that's one of the things that, kind of goes in cycles. The other thing that goes in cycles is the risk on, risk off. So one of the ways that we can track that is to look at the spread of a high yield bond, which is a junk bond, which is a lower investment grade. It's not investment grade. So investment grade would be triple B and above. So investment grade bonds are, the ones that, banks and insurance companies and pension plans invest in. and rarely do they take on the high yield debt. Some do, and those are the ones that we usually hear about on the news. But the high yield is what we would call riskier. So the current high yield is about 6.7%, which means it's about only really about 2.9% above the corporate, the triple B. So the investment grade. So when the spread between investment grade and high yield is that small, what that tells us is that people are taking on a lot of debt and they're not really demanding the higher yield for the additional risk that they're taking on. So that sort of goes to show with all the other things that we're seeing that people are sort of a risk off theory right now, still being very risky. And you can see that that really is the lowest spread that we've seen going, well, at least through this chart. It's never been that low on this chart. The average spread is about 4.1%, and we're down to about 2.9. So again, since the war, that may have changed a little bit. We'll continue to track that, and I'll report back next quarter. Um, the other problem is corporate debt. So as interest rates have gone up, corporate debt has become more of a burden, and a lot of companies are having to sort of re-roll their old tranches of debt into new tranches of debt. So those bonds have matured, and they're rolling those into new offerings, and they're having to pay 2 or 3 times the rate that they had to back, earlier on, because we were running at about, 0 to 1% there for, 6 or 7, 8 years, and corporations loaded up on those bonds at those lower rates. Now that the rates are higher, they're having to refinance at a higher rate, and that cuts right into the bottom line. One thing that's a little bit surprising to me is commercial real estate. Now, in my building, we're probably about 80% unoccupied, and I see that around Atlanta, but I also read about it in other places in California and Texas and Florida. This is just commercial real estate. This is not residential real estate, but it was underwater there for a while and has somehow climbed back out from the abyss, and we're just going to have to continue to follow that to see what happens. But from my perspective, it sure doesn't look like we're getting any new residents or tenants in this building. So let's now look at what some developments have occurred, and the biggest developments that everybody watches, of course, is the Fed funds rate. So the Fed met again, and they've decided to, leave the rate alone, which is probably a smart thing because inflation is stickier than we thought, and we knew it would be because you just can't turn inflation off like that. It takes a lot of time to start it, and it takes a lot of time to slow it down, and we've never been able to reverse it. So forget that. I was in Publix the other day and just happened to notice that 12 donuts, 12 Krispy Kreme donuts, just the regular Krispy Kreme donuts, is now like $14. So 14.50 for 12 regular donuts that aren't even hot. So inflation is real, and if you go to the grocery store, you'll definitely see it. My wife sends me there every once in a while, and I'm forced to look at it. So Fed funds rate has come down. We're now at about the three and a quarter, 3.5, 3.25 rate. Um, and these little blue dots here are all the different Fed governors, and they're the ones that vote on, what the Fed rate should be. And they've all kind of averaged out to be about, 3% in the longer run. So maybe we're looking at a little bit of a lower rate in the shorter run, but in the longer run, maybe around 3.25. 3%. So that's kind of what we're looking at. And then when you tell the market, it doesn't look like we're going to be able to do a rate cut, then everybody gets upset and the market drops. And so it's like morphine. You want some more and you just can't stop having it. If we look at interest rates over time, we can see a trend. And one of the things that I've always pointed out and makes a lot of sense is, these gray lines are recession, so keep those in mind. This is the Fed funds rate. This is going all the way back to, I guess, 1950. So you can see how when we have a rate increase, we have a rate increase because we've had inflation. We've had inflation because we've had low rates and we've had stimulus. So when those things come together, we have inflation, and then the Fed decides to raise rates. So we raise rates, and oops, we did it too much. Market crashed, we got a recession, we got to turn that around and then have stimulus and lower rates. And then we do that, we have inflation, and then we have to increase the rates, and we do that, and then oops, market crashed again, went too far, too fast, too much, and we have to reverse it, and then we have the recession, and then it just is a cycle, and it happens almost every single time. There's not one here, but this is 1987, so they just didn't put the gray line in here. But any of you who were around in 1987, you remember that that was a very, down time. So that was when we had rates go down, reverse the rates again, inflation, reverse the rates again, and then it's just been like that for, ever since. Except that this time they've started dropping rates before we've had a recession. So that's what they call the soft landing. And so far, so good, right? But they were dropping rates here, and then we had a recession. But again, that was the pandemic, so all bets are off there. But this is something that we're watching, obviously, because if this follows the trend, then we're sort of kind of, we're looking at a significant market drop or somewhat of a correction in the broad market. And that probably just could be because the technology sector is rotating out of favor. I mean, it's got to happen sooner or later. It's going to happen sooner or later. So we just have to be aware of it, and I think we are. We're well prepared for it, and we are positioned perfectly. I think as perfectly as you can be. And we have a shopping list of stuff that we want to buy. And we're just waiting for a little bit more of a drop before we start going shopping. So I'm excited about that. It's been a long time coming, but our gold and our silver have been doing fantastic, and we do need to trim a little bit of it, a little bit of that. Mortgage rates have come down a good bit, and so we're now right around 6%, and still, real. Residential real estate is still sluggish. If you ask people that are in that business, they'll tell you that it's not quite nearly what it was when rates were low, and especially when COVID was happening and people were moving to Florida and Texas and everywhere else. So those states that got a lot of influx of people from the COVID migration are seeing some slow movement. I know that in my neighborhood, generally, because I live right next to the hospitals, generally when a house goes on the market, within a week, there's an offer. I've had a neighbor, I think their house has been on the market now for 2 months, and no little sign. So I keep watching. I hope the best for them because they're good people. Okay, so our bank rate policies, central banks, just not just the Fed, but every other bank except the Bank of Japan. So this is not good news for those people who were doing arbitrage because they were borrowing money from the Bank of Japan and then moving it over to the central bank of the United States and investing it here. And then you could borrow for 1% and invest for 4 and then arbitrage the difference. So when those things close, when that gap closes, that becomes more challenging for them. But you can still see you can do it. You can borrow for under 1% and reinvest at about 3.5 with almost no underlying risk, but you still have currency risk and inflation risk and interest rate risk and all those other risks. But as I said earlier, one of the things that we have been looking at for a long time since the interest rates started going up was the yield curve. So you may have heard people talk about the Treasury yield curve or the bond yield curve and how that curve was inverted. That means that the shorter term bonds were paying more interest than the longer term bonds. Okay. Now that makes sense when interest rates are going up because you're thinking, okay, why do I want to invest in a 5-year bond or a 10-year bond when I know in a couple of months those rates are going to be higher? So if interest rates are going up, you would have a tendency to stay on the short end and wait for those yields to come up. So what has happened is now that has settled down. So now you can see that as you get longer, that the yield goes up. All right. So the 3-month, it pays less than the 6-month. The 2-year pays more than the 6-month. The 5-year pays more than that, and et cetera, et cetera. And so that has started to definitely flatten and uninvert. So vert. But you can see that from 3.3 month to a 30-year, 373 to 493. I mean, that's not that huge of a difference, all right? But that's definitely the direction that we're looking for. And then, of course, one of the things that we've been watching very carefully, including interest rates, is gold and silver. Those have done sensationally well in the last few months, and it's been volatile. I mean, every day, there's a lot of movement, but Gold is hovering around close to, I don't know, 4,800, 5,000. Silver is around 80, 85, 90. Um, as I said, we're going to need to diversify out of some of that if it goes much higher, and we have a lot of it. So we're going to diversify out of that and buy some other things. What are we looking at? Well, mainly we're looking at, remember I was talking about the value stocks. So we're looking for value stocks that have a price earnings ratio, around 15 or maybe less. They're paying dividends. And the one thing about value stocks that if you're going into a recession is if they're paying dividends and they have cash flow, they can turn around and buy their own stock back. And there's rarely things that are better than that for a shareholder because they're taking that stock out of the market, out of circulation, and that just makes everybody else's shares, your shares, more valuable. So value stocks can do that, especially stocks that have free cash flow, and those are the ones that we're looking at. So stay tuned. It's going to be fun. But one of the reasons that gold and silver have just gone gangbusters is because our debt has gone gangbusters, and not in a good way. We're over 39 trillion with a T, and we're closing in on 40 trillion. And I'll be honest with you, I just don't see it stopping. I don't see it slowing down, and it's just not sustainable. It's not going to go on forever. It never does. We're not the only country that's gone through this. We're just the biggest, and when we fall, it's going to be hard for everybody. Now, I don't know how we're going to fall, but I've been to other countries where their currency has collapsed over time. Brazil, for instance, has had a currency collapse 8 times in living memory. And each time on Friday you go to bed and you have the cruzado, and on Monday you wake up and you have the real. And maybe on Friday you had 100,000 cruzados, but on Monday you only have 1,000 reals. So that conversion takes place, and then that just gives them the go ahead to go ahead and inflate that money away again. So fiat money is just the worst. It just destroys us. And then this debt that we're going in. I mean, for those of us who have been alive through all of this, it's like we've had this credit card that we've just been charging everything without even thinking about how we're going to pay it, who's going to pay it, or if it's ever going to get paid. Um, so lucky for us that we lived through it and we've had this fantastic time, but our grandchildren are going to hate us. So I think that's already starting from what I can see. Um, so who owns this debt? Well, we do mostly, and that might be the good news. Everybody else has dumped it for the most part. I mean, the gray lines and the gray amount in here is owned by, basically agencies, government agencies, federal agencies, state governments, that kind of thing. And then, believe it or not, this other blue portion here is owned by the rest of us. We know that the Fed is in there for about 7 trillion. And then the insurance companies, pension plans, you and me, the treasuries from our account are in this blue section. But if you add the gray section and the blue section together, like basically 76% of this debt, 3/4 of the debt is owned by US holders. So we're not dumping it. No one here is dumping it, that's for sure. Canada is dumping it. China's dumping it. Brazil's dumping it. The Europeans are dumping it. I don't think we have anybody, honestly, that's buying it, and that's one of the reasons just is not doing well. I mean, today, for instance, stock market's been down now for pretty significantly since the war started, but bonds are not up. Bonds should be rallying 10%, and they are not. In fact, they're dropping. Why are they dropping? Because the rest of the world hates our warmongering ways and is dumping our treasury. So it's not even really safe to fly around. I mean, I fly around. I use my Brazilian documents. I'm afraid to say I'm American. And yeah, I make a good Canadian too, but you got to be careful these days because just out of the blue, people hate Americans. It's not out of the blue. It's been building. You know that. The central banks have been reducing their balance sheet because this is where inflation lives. Okay. The balance sheet of the Federal Reserve is essentially the number of treasuries that they own. Well, they bought these treasuries from the Treasury Department, hence the name, and then that Treasury Department sends those to Congress. And what does Congress do? Just spend it out to everyone. But the important thing is that the Fed buys these treasuries, okay, with money that they just create out of nothing. All right. You can't create money out of nothing. I can't create money out of nothing. The Treasury can't even create money out of nothing. The only people that are licensed to do that is the Fed. And it's only been that way since basically 1913, 1917, that period of time in there. I really would encourage you to read this book, The Creature from Jekyll Island. You don't even have to read the whole thing. Just read the first half. And if you can walk away, read the first 20 pages. How about that? Read the first 20 pages. And if you can stop, then you can stop. But if you can't, then you're going to be educated in what's really going on. But what's happening here is when we had COVID, they injected $7 trillion of brand new money into the economy, and that's why donuts are 14.50 for a dozen. Right? When I was growing up, they were 3.99. Um, so I don't know what to tell you about that, but you can see that they're reducing their balance sheet, which means they're letting those treasuries unwind. That's a good thing because it reduces the amount of money that's in circulation. It's a bad thing because it could potentially, it's like pulling cards out of a house of cards, which is kind of what our stock market is built on, because our stock market is built on all of this freshly new created money. And so you put all these things together and you have concerns. You also have concerns because the leading economic indicators are still at a low, they're still negative, and they're pretty wide. So in every single instance where we've had negative indicators, we ended up with a recession. The gray lines are recessions. So negative indicator recession, negative every single time, every single time. And here we are now with all of this negative, what leading indicators that have been negative. Hasn't been very deep, but it's definitely been wider than any of the others. So you have to take that for what it's worth. But again, that's another thing that we have to think about and be concerned about. Personal savings rate, when we went through the pandemic, people's savings rates went up, and that was fantastic. People were like saving like 15%. That has definitely changed. And so we can see where personal savings rates have dropped significantly. And there's a lot of personal debt out there, right? We see that all the time. Consumer sentiment is sort of a self-fulfilling prophecy because what happens is people feel good, they spend more money. They spend more money, the corporations have more profits, more earnings, the stock price goes up, people feel good, they spend more money. When people don't feel good, they don't spend money, they don't shop as much, the earnings are not as good, the stock prices are dropping, the 401k balances drop, and then they don't feel good. So they don't spend as much. You see what happens? And if you take a look at this, really, we're right back to the 1980 levels. Hasn't been this negative for a long, long time. So that has a tendency to sort of drain or have a drag on the economy. But one thing's for sure, we're definitely building lots of rockets and bombs and planes. So that part of the economy is doing well. With that, consumer sentiment at all-time low, we're just going to let that be it. I'm going to take any questions, and if anybody has some questions, I would love to get to those. And I forgot I should have said something about that initially. It looks like everybody gets what I have been saying today. Fantastic to see all of you. No questions so far. Then I'll just leave you with this. Any of you who have been with us in Magellan know that we have this tri-headed uh, creature here, and we have the legal team, the tax team, and the financial team. And our claim to fame is that we can, behind the scenes, coordinate all these efforts. And it's from taxes and investments. I can tell you it's a huge thing because, most CPAs are just sort of recording history when April rolls around. And what we do is do some forward thinking in November, October, November, December, because by the time January 1st rolls around, you can't do anything. Um, so we like to be proactive with the taxes, and the taxes are the number one expense when it comes to investments. And like charitable giving, for instance, you would never want to do charitable giving from a Roth or from your savings account. You want to do charitable giving from your IRA or for some high capital gain type of thing. So there's a lot of nuances in life, like with the legal stuff, joint tenancy rights and survivorship versus tenancy in common, and the way we can use step ups capital gain step up. So a lot of little nuances that, really take a whole team of people that get their brains together. It's not a one-man show for sure. Listen, I appreciate you guys tuning in. I hope to see all you soon in person, and be safe wherever you are. Be careful if you're traveling. I would avoid that for now. And otherwise, stay very safe, very healthy, and please stay in touch. Have a great day. Thanks.